What is going up, guys? So I hope you're all having a fantastic day today. So we're going to be talking about the most important indicator that I use for trading or any really sort of investing type deal. Alright, so we have ticker symbol Apple up AAPL here, and as you guys can see, it's on the 1 day 1 minute. All you gotta do is click here, 1 day 1 minute. Alright, click out of that. Now let's make the screen a little bigger so you guys can see. Alright, so if you guys look close, you guys can see we have 4 different lines. We have the kind of light pink, then we have this yellow, we have a darker purple, and then we have a blue. It's a little more easy to see when you're zoomed in here like this. So we have 1, 2, 3, 4. As you guys can see, these lines are called moving average lines. So, pretty much they average out all the closing prices and they make these lines. So, why is this one closer to the candlesticks than these other ones? So, this one right here is a 9-day moving average line. So, they take the 9 days, they average out the closing prices for each, and you get this line. And then this one right here is 20, 90, 200. Those are the 4 I use just because they act as very, very good support or resistance points. So pretty much, let's go right through here. You see the yellow line right here. Pretty much this is the 200-day moving average line. So the past 200 days averaged out into this line. This one is this line acts as a very strong support or resistance point. So, as you guys can see, it had a very tough time breaking over it. So, it tapped this line once, twice, and it broke over and then immediately got rejected and fell back down. So that's considered 2. This one, just because it did consolidate after it, that broke through it. And then right here, it tapped it again, immediately got rejected and failed. So, this is the most important indicator I use, because you can look from here, and as you guys can see, it tapped this 90-day and got bought back up and then continued to rally on the 9 right here. So that is a good way many traders actually find good entry points and pretty much just get a good general direction of if the stock's going to go up, down, consolidate. Because okay, if let's say you're looking at this, whoa, that's very, very zoomed in. But you can say, okay, it tapped this 90, and now it's riding this, 9 moving average line. So pretty much, if you went long here, you could say, okay, I'm going to set my stop below it, because as you guys can see, when it breaks through it, it gets pretty much sold a lot. It falls a lot more. And then it tests this one. So pretty much these are just 4 levels of support or resistance points, because as the 9 moving average line fails, the next one it's going to try is the 200. And if that one fails, then it's going to go test the 90, then the 200. So as you guys can see, right when it broke through this 20-day moving average line, it actually retested it. So it came up, tapped it here, and now it used this as a resistant point, and it continued to fall back down, broke through the, which one is this? Broke through the 90, tapped the 200, and now it acted as a support point, So if you guys watched, you could say after you saw, pretty much after you saw this right here and the stocks right here, you could say, okay, I'm going to go long, at 209.57, set my stop right below it at 209.24, and the risk would be upwards of this resistant point back to 211. So that's about a 3-to-1 risk to reward just by judging these moving average lines. Also I do use the RSI. You guys can't see it. Let's move up a little bit, but the RSI also is very important, because you guys can see if you're chasing a stock just because if it's overvalued or undervalued, you guys can make pretty good trades off that. But I made a separate video on that. But yeah, I love moving average lines. I believe everybody should use them. But as you guys can see, if you would have went long here, you would have gotten stopped out for just a small loss of 20 something cents per share, and then it just continued to rally, and it did tap this multiple times to see if it could get a break over it. More likely, I would have waited. I would have not, went long there, just because I like to do a resistant breakout strategy. I'll actually show you that here. So pretty much this 200-day moving average line, you wait for a break over it. So you would most likely set an alert, or you would just watch the stock closely. So the stock just continued to fall, and the line we're looking at is this yellow. We're looking for a break over that. So, it almost tapped it, got bought back, got sold back down, tapped it multiple times here, using it as resistance. They continue to rally. All right, right here. See, I never set it close. I always set it probably maybe 40 or 50 cents over this. So probably around 237 or 240 or 50, just for confirmation. So just continue to rally. Nope, that's 220. So we would have just continued to wait for continuation here. Nope. We would have waited for continuation or some sort of confirmation, and actually we most likely would have went long around here, actually, because that's 260, so 250 confirmation, 270. I mean, we could have had a scalp on this, but that I would have most likely never seen that, just because it's the end of the day and I don't really trade that much. But realistically, you're gonna want to use this strategy right here. So as you guys can see, the yellow, the strategy I'm talking about most likely works better early hours, so like from 9:30 to maybe 11:30, and then once you get to afternoon trading, I don't normally do it. But so you wait for a tap on the 200 moving average line or the 90. So we had a tap on here, and we wait for the first break over the red. So around right here, we would have went long at 209, 209.78, setting stops below this resistant point or support line, excuse me. So we would have set it at around probably 209 flat, just because whole numbers act as a stronger support or resistance point. So we would have most likely set it here, and then set our stops at 209, and just moved our stop up as the stock continued to rally. Right here's that 1 minute micro pullback here from that kind of consolidated here. This would have been a good area to go long on, just so you aren't buying at peak points, and the stock kind of took a little bit of a breather and then continued to rally. And then here it looks like it's oversold on the RSI, or overbought. Man, I'm getting all my words all messed up today. But you can use these moving average lines for multiple things. This is just Apple. This is a large cap company. So if you pull up a smaller company, let's look up top gainers here, just to see what have happened. All right, so that's alrighty. So IMPX here, 27%. So you guys can see it tapped this moving average line multiple times, broke through these, maybe a short opportunity there. But let's just keep looking here. This one, just consolidation, nothing much. Most likely a merger of some sort. CIFS, beautiful gap and go setup right here. Over pre-market highs, going long, so long at 230, taking profits at 250, 246, around there. Using these support lines, seeing if the stock will use this 200 as some sort of support. It looks like it did because it tapped it here, got bought back up, almost tapped it here, got bought back up. So, this is why many traders actually use these, because they do offer very, very good support or resistant points. So, that's it. I hope you guys enjoyed this video. Please try to like, subscribe, comment if you are new. If you want to be part of our trading team, I'll put it down below. It's a 100% free chat room. We talk about stocks, pretty much just everything, long-term swing trades, stuff like that. So that's it, though. Remember to always stay happy, stay positive, and I hope you guys have a fantastic weekend. All right, guys, take care.